Hey there, welcome to the closing bell on the 7th of October. Now, the big question on everyone's lips, is this rally the real deal? Are we seeing a major low getting formed? Are the central bankers going to back off after really we're just looking over the cliff with the UK bond market imploding, etc., etc. And I think the market personally is getting a bit ahead of itself. And I want to show you what sort of things I need to see before I will get a bit more bullish. There's no doubt this could be a spot where a bear market rally starts from, but there's a lot of resistance overhead. So I just want to make this video really about setting up what the warning signs are that are out there and what you need to see before you can potentially stick your nose above the parapet, as I keep saying, and maybe buy a few things. But yes, there's still a bit of work to be done. So let's just have a quick look at a few charts. I want to start with the UK bond market, because really that was a pretty serious thing that occurred there. And I just want to update you on what's going on there, just so you realise that it's not really all over yet. So here we see the UK 30-year government bond yield. And, you know, what an amazing move we've had since the start of 2022, going from below 1%, really bad move to the upside. And then, boy, going from 2.4 to 5%, and really a crash-like sequence there, which is showing you forced liquidations, pension funds, etc., the losses piling up, the volatility exploding. A lot of their calculations and algorithms will be telling them, watch out, time to deleverage. And when everyone's trying to get out the door at the same time as those losses pile up, it can turn into a stampede. And we had the UK saying they were about to start their own quantitative tightening. And, you know, there's probably people trying to front run that as well. And all hell broke loose. And, you know, I'm also hearing that those pension funds that have taken big losses, that have had a big VAR shock, they're having to sell other assets around the world to lower overall exposure. So those sort of contagion things can spread out. So it is definitely a big event that you don't want to ignore, that UK bond market collapse. And the thing I want to point out today is that yields are creeping higher. Now, we've had the intervention come out, which is all well and good, saved by the bell. But after that move to the downside, where yields dropped you know, over 1% in a day, basically, one of the biggest moves ever. This last few weeks has seen, or last few days, has seen those yields creep up from 3.6 to 4.4%. So the selling is still around. This trend is still moving to the upside in a very strong way, isn't it? Just on this daily trend. So, you know, even though they've stepped in to print money, I think they were saying around mid-October was when they were going to ease up on that. And we're approaching mid-October pretty quickly. What is going to happen exactly? There's obviously a lot of losses through the system now. There must still be some forced sales out there. Are yields going to continue ratcheting higher? We've also had the Fed coming out saying, you know, really backtracking from all of this talk that they're near the peak and they're going to slow down and all this sort of thing. So the market just might be getting a bit ahead of itself, getting too bullish at this juncture. So moving on to the US 10-year bond yield, which is one that we've been following very closely. And last week I was saying, I've just got a few lines in the sand. I really need to see those bonds below around 3.25, 3.3% before I'm going to get too excited that this big sell-off in bonds may be slowing down. and back above 4%, well, you know, you've got that idea of Armageddon coming back into play. So it's actually, you know, sold off from 3.6% to 3.82% in the last few days. So the selling is back in those bonds. And if we're going to look at the long-term chart of those bonds and the way this is moving, you know, how can you say that this sell-off is done yet? As I was saying, that around that 3.3% region being the level I'd need to see yields below before I'd get too excited. You know, we're still well above there. And it's been a major breakout, multi-decade highs in these bond yields. So this is not necessarily over yet. And crack up through 4%. I mean, who knows what could happen? So that's just the chart saying, you know, the trend to the upside in yields doesn't look like it's over yet. It may be, but I'm going to need to see yields falling before I'm going to get too excited, falling a lot more than they have so far. So moving on to the S&P 500. And last week I was saying to you, look, it's at an incredibly important level. If it keeps going, we're looking at, you know, crash-like sort of situation. But at the lows, you don't start shorting markets because that's where you get those false breaks, the short squeezes. But the fact is, the big picture is bearish. So I need to see a bit more proof before I'm going to get excited about this rally. And the way I look at it, and you'll remember last week I was saying, look, you know, you get these false breaks of the lows that create the short squeeze. And I've shown you many of them in the past. Selling off, short squeeze, breaks through the low, short squeeze, breaks through the low, short squeeze. This is just how markets move. It's how it fools everyone. And we're in a similar situation here, major low, short squeeze. But I was saying, look, there's lots of selling pressure up here. And for me, it was around sort of 3,900 to 4,100 even is a region there should be lots of resistance. And until it really heads above those levels, I'm not going to get too excited. And you can see we've already got a bit of selling pressure coming in. And look, there's no weekly buy pivot as yet. So that's sort of my little line in the sand that I want to see. Maybe you'll remember, if you've been watching these for a while, I was calling this short squeeze that we saw there. And I waited until we saw the weekly buy pivot. Right, so when prices are heading down, I'm just following along, looking at the lowest price candle, and I need a weekly close above the high of that trading range. And we got that on that week there. And look, then there's lots of work done, going back into buying support before heading off on that big short squeeze. So similar thing here, I'm just going to really make the market work hard at proving to me that it is going to go up. So that would mean next week, because this is actually the lowest price candle was created this week. Therefore, I'd need to see a weekly close above the high of this week's range next week or in a few weeks or whatever. So that would mean, let's say, for example, we do have a good week next week and prices close above the high of this lowest price candle. That's the sign that potentially we are going to see a bit of a short squeeze. And until then, this can just be a short-term move to the upside, which meets heavy resistance. And tell you what, if things turn straight back down below that low, things can go pear-shaped pretty quickly. And then we're talking about that bigger picture move that I've been mentioning, which is looking at the whole rally from 2020, contemplating the midpoint of that, the point of control, you can see there. Below there, you know, above that point of control, you're often seeing lots of buying pressure. And then once it cracks through that midpoint, sometimes it can just really go. And there's not much support until it heads down into that buy zone area. So that's the setup. It's a pretty dangerous setup to be buying. If you're buying this short-term rally, tell you what, you've got a stop loss below the low of the move. You're not sticking around to find out what happens because below there, it can look pretty terrible. And if those bonds do keep selling off, the market will be surprised if those US 10s start flying through 4% anytime soon. So it is certainly a very difficult environment. It's not one to be getting too cocky in, but the setup is there after this big rally that it could turn into a bigger squeeze. And I have added a bit of a position to one service. I'm looking at in another one, buying a few stocks if this really does have legs. And for sure it can, because we are pretty oversold in the short term. And if the Fed comes out and says, yeah, look, we're going to back off a little bit here because they are worried about what's going on with that bond market crash in the UK, look, we could have a big rally to the upside for sure. So you've just got to sometimes sit back and let the market tell you what it wants to do, have lines in the sand, like I'm saying to you with that weekly buy pivot. I'm going to wait until that happens before I get excited and go from there. So that's really how I'm seeing things at the moment. Take this rally with a grain of salt until there's a bit more confirmation. Keep an eye on those UK bonds and the US bonds, because that's where things can really go pear-shaped if the selling picks up. And remember that the contagion can spread. As those losses spread from those big institutional investors, they will start hitting the bid elsewhere to lower exposure. And I think really with volatility picking up across the bond markets, that sort of thing, often you can see a deleveraging process, and that can get pretty heated when it picks up steam. So we're not through this yet, I don't think. And it'll be interesting to see what happens next week, whether there is actually some follow through buying. And I shall come back next week and let you know what goes on. So I'll talk to you then. Cheers.